The title of this talk is shown in white writing on a red background: Entrepreneurial Myths, Legends and Public Policy by Marc Cowling, College of Business, Law and Social Science at the University of Derby. The background has the University of Derby logo of 3 peaks and a photo of a young woman holding a virtual reality headset. To the right of the slide is the presenter, Marc, talking via his webcam. He is a Caucasian man in his 50s. He has short brown hair and glasses. He's wearing a white shirt and has a dark tie.
Thanks to everyone for giving up their evening, even though we've got limited opportunities to actually do anything these days. But thank you for taking the time.
Text animates on screen saying Professor Marc Cowling, College Head of Research and Innovation.
Can we go on to the next slide, where I'll just quickly go through some thanks to people who were really important and key in the development of my career at various stages.
The title of this slide is Personal Thanks. It lists the names of people Marc would like to thank, which Marc will read out.
So my dad, a kind of unachievable benchmark was set. He won the Queen's Award for the highest degree mark in the UK in his graduating year. He discovered that he spent a career measuring the social costs of monopoly power, and did some key work around measuring the social costs of monopoly and how that impacted on firms and consumers. He was my harshest critic for sure, but a very fair one. Even up to the point he passed away 2 years ago, he'd always taken interest in my work, and he'd asked for copies, and I would get them back a few days later with red pen, like he was marking an undergraduate essay. So a harsh critic, but a fair one. And my mum, she set up a recycling project, which is a social enterprise which she ran for 35 years. And its aim was to provide skills and employment training for people with disabilities of all kinds. And I think from those experiences and in my own work on intersectionality, inequality, it was very apparent that disability, although the disadvantaging characteristic with no voice, it's the single most socially and economically disadvantaging characteristic. David's story, as Camille said, my mentor in my formative years as an academic at Warwick. But what, apart from his general support and mentoring, he always said there's no point in doing research if you can't make a real difference in terms of addressing important issues and developing our understanding. But even more than that, about connecting with people who could meaningfully use that research. Nigel Meager, my boss at the Institute for Employment Studies, he was a really great and deep thinker and a champion of social justice issues. He also allowed me to put the same timesheet in for approximately 5 years and turned a blind eye to it. So I'd thank him for that. Will Hutton, my boss, a larger-than-life character at the Work Foundation. He was absolutely mad to work for, but he was absolutely full of ideas and energy, and that kind of rubbed off. And he always wanted to know the answers to urgent and future problems. So very inspiring individual. Rebecca Harding, we had some great years at London Business School and the Work Foundation. Hugely inspiring again, and she really had a great feel for the issues of the day, or even the issues that we would be facing. And we always directed research in new directions. And we actually co-authored the first social enterprise report in the world, and also developed a classification of different types of social enterprises and entrepreneurs, which is still widely used today. Deborah Humphreys, she's VC at Brighton. She was an academic who wanted to know, as she would put it, the truth, the real answer. And she used to, I wake up early and I always get to work early. And we used to have meetings at 7 o'clock in the morning. And she'd say, Mark, can we have a coffee and a chat? She said, I want to know about pay inequality at Brighton. And I said, fine, but we need to do it properly. She wanted to know about the USS pension scheme, its viability, its liabilities, etc. About patterns in research income. But always, she always said, tell me what data you need and I'll make sure you get it. So we did a fantastic report with the full staff, anonymised obviously, records, pay, promotions, job status, college, etc., to really understand potential pay inequality at Brighton, which is a really fundamentally key step, way above this reporting average salaries by gender, by ethnic group, by disability, etc., etc. And finally, Camille, Martin and all at Derby for making me feel really welcome during my time, helping me out with my complete incompetency around technology and systems, understanding Derby, and generally just making my time at Derby really enjoyable. Finally, a bit on the family front, my daughter Izzy, who's building a career at Wiley in comms and marketing, for preparing this lovely presentation, which is far beyond my capabilities, as most people will know. My favourite nephew, Joe, who's just started senior school, and I hope, Joe, A, you'll understand what your uncle does for a living, and B, it might inspire you to go to university when you finish school. And I believe my son Charlie is desperately trying to come up with a difficult question as we speak. So next slide, please. Okay, this arose, what this actually is a graphical representation of a production function which is core to economics, but how we understand the relationship between the inputs that we use in production and what comes out the other end.
The 3 pillars. At the bottom in a blue block are the words small business. At the top in a red block is the word productivity. 3 arrows point upward from small business to productivity. The arrows are labelled financial capital, human capital, and innovation.
Now this was developed in this form for an Australian government policy document which formalised our thinking about how you get from a small business to a productive small business. Next slide, please.
Key interrelationships. A Venn diagram shows 3 interconnected circles: human capital with a silhouette of a head, financial capital with a $sign, and innovation with a light bulb.
And for me, the problem or the tension between government and knowledge from research and economics is typically government will have an innovation ministry or part of, here it's part of BEIS. It'll have Treasury, HMRC, which deal with financing issues. Then it'll have a department for work or labour or skills or something like that. And generally that they don't speak to each other, which is a problem. They formulate policy independently. So we'll have an innovation policy, a finance and investment set of policies, and a skills agenda, etc. But my research very clearly, or the more interesting research that I've done, recognises the interdependence between the three. So the people side of things, the talent, the skills, the investment capital, and the innovation part. And certainly you can never get innovation or growth at the firm level without talent, without financial capital, and without good ideas. Independently, nothing helps. Doing more of one without the other two just collapses, and you don't get growth or increase in efficiency. And in fact, we looked at the causal chain in a BEIS report a few years ago, and it actually, the only way it works in a causal sense, if you want growth and innovation, or more growth and innovation at the firm level, is if you've got talented people, skilled people in place, and only then does adding more financial investment capital lead to innovation and then growth at the firm level. In any other order or combination, it doesn't work. So having lots of investment capital, great ideas, and then trying to find workers, talented workers, to make it happen doesn't work. You must have the talent in place in the first place. Okay, next question, slide, please. Okay, does the future depend on new business?
The slide posing this question shows an icon of a magnifying glass within a red box with decorative wavy lines inside.
Arguably, my whole career has been lived on the back of governments since Margaret Thatcher in 1978-9, believing that to be true. So really, I've always been interested in finding out if the future does depend on new business, because certainly we've got more of them with consistent public policy support for new business startups, the growth of existing small businesses, etc. Next slide, please.
Notable believers. A red silhouette of a head on the left of the slide has arrows pointing out from it toward three names at the right. At the top is David Cameron, 2012, with the quote, "So if we want to make our economy stronger, this is where we've got to focus our firepower, on encouraging more people to start up and helping small businesses to grow." In the middle is a Margaret Thatcher quote from 1984, which Mark will read, and finally at the bottom is Tony Blair, the Entrepreneurial Society, and rather than a quote, there's a picture of a blue sky with clouds.
So just a few quotes going from Margaret Thatcher. So small firms very clearly linked to the creation of jobs and of wealth. And it was about freeing up the latent talents of society, which in her agenda was also tied up with the large corporate, large unionised sector of the labour force. So she felt that small businesses were the vehicle by which the latent entrepreneurial talents would be freed up. There's also a sub-agenda which would be to reduce the welfare dependency of the labour force. Supported by Tony Blair, that was quite funny, the Entrepreneurial Society. We got a call in a year out from the election in '97 from Tony Blair's people saying we need a small business policy and we don't have one. So it's largely Andrea Westall and myself who actually sketched out, which was the book, The Entrepreneurial Society, an agenda and a policy agenda which Tony Blair's government then enacted when they were elected in '97. So all politicians of whichever political shade have been supportive since the late 70s of entrepreneurship, small business, and particularly business startups. Next slide, please.
Policy issue 1. Text asks, how efficient are small businesses? And a bar graph shows efficiency along the x-axis and number of employees up the y-axis. It starts with self-employed people in a bar at the bottom, and bars above it show businesses with 2 to 4 employees, 5 to 9 employees, and so on up to the top bar for businesses with 500 employees and above. Marc will explain the data in this graph.
So I thought, you know, these policies have worked, or this political will to have a more entrepreneurial society has clearly worked in the sense that they've supported more and more people to start their own business, become self-employed, etc. But the underpinning policy myth was that smaller businesses would be more dynamic, more creative, more innovative, and hence more efficient, and they'd destroy inefficient larger businesses. So we'd get productive churn where old inefficient industries, businesses would be replaced by new dynamic entrepreneurial firms who would grow quickly. And some do, but not many or not enough. This shows essentially a scaling where we set the best business in each class to 1, so on the right vertical axis. Then the average small business of its type is benchmarked against the best in class, if you like. So we see two things. Even the largest businesses in the UK, on average, are only about 85% efficient compared to the best in class. But as we go down the size kind of classes and end up with a self-employed or single self-employed, they're operating at about 68% efficiency on average. If we go up the micro business classes, they're still well below 70% efficiency. Even medium-sized companies are not even 80% efficient on average. So there are certainly question marks about whether having more small businesses, more self-employed, helps us economically, because productivity is the only thing, or increase in productivity, are fundamental to raising the incomes and wealth of the population. Okay, so keep that in mind as we progress through. Next slide, please. So the broad question is, do entrepreneurs sleep? But the real question is, given this consistent government support for 40 plus years and a very favourable tax system for the self-employed, for small business owners. Next slide, please.
Policy issue 2. It has 2 bullet points. The first says, since 1979, Margaret Thatcher's government, the UK tax system has been incredibly generous to those who choose self-employment and business ownership. The second says, this policy support reflects an underlying principle that if we financially reward entrepreneurs, they will work harder and create even more of the good outcomes that we all benefit from: jobs, innovation, productivity, etc.
So my real question is, given that there's been consistent support for a very favourable and generous tax treatment of self-employed and business owners. Is it the case, if we effectively financially reward entrepreneurs, that they will actually work harder, supply more effort, and create even more of the good outcomes that we all benefit from? More jobs, more innovation, more productivity, all the rationales that underpin the government support for more self-employment and more small business. So what I'm looking for is clear evidence that the tax system or its generosity has incentivized self-employed people and small business owners to work harder than waged employees. Next slide, please.
A line graph titled Working Hours Distributions shows hours worked from 0 to 150 on the x-axis and density from 0 to 0.6 up the y-axis. It charts ISE in blue, JC in red, and waged in green. ISE and JC both follow a similar path which peaks at almost 0.4 density at 40 to 50 hours, while waged has a peak of 0.6 density at about 40 hours.
That's a bit unclear, but the green line is, these are just distributions, ignore the density bit. So the green line is waged employees, and at the bottom, the horizontal axis is hours worked per week. ISA are individual or solo self-employed, and JC are job creating self-employed or small business owners. Next slide, please.
Waged employee hours. A graph shows kernel density estimate with hours worked on the x-axis and density on the y-axis. It shows a peak at close to 40 hours.
So what we see for waged employees is a huge concentration between 35 and 45 hours per week. Most waged and salaried employees in the UK work within 35 to 40 hours a week. On the very left, we've got a little spike which accounts for the part-time workers, but very few waged employees work more than 50 hours a week. So that's our benchmark, and we're looking to see if the solo self-employed and job creating small business people work more hours. So next slide, please.
Solo entrepreneurs' hours. This graph of a kernel density estimate shows a line with a much less pronounced peak than the last graph.
Here, we don't need to even look at the numbers, but for solo entrepreneurs, self-employed people, we see that the distribution of hours worked spreads quite significantly. And actually, the average has also shifted to the right. So the bulk of single self-employed people work between 40 and 55, 60 hours a week, which is on average more than waged employees. And we get also a longer tail to the right-hand side, so that there are more solo self-employed people who work very long hours per week. Next slide, please.
The title of this graph is Job Creating Entrepreneur Hours.
Then if we look at the job creating entrepreneurs, again, we see a shift in the whole distribution to the right. So on average, job creating self-employed work more hours per week than their solo self-employed peers and waged employees. So we're looking at 40 to 70 hours a week for job creating self-employed. So I think we could argue on that basis in terms of effort as measured by hours per week you put into your work, that certainly job creating self-employed and solo self-employed do work more hours on average, particularly at the very high hours end, of the spectrum than waged employees. And the favourable tax system has played a major part in inducing more effort, because you get a higher share, you get to keep a higher share of every pound extra you earn than a wage employee would if they worked excessive hours. So policy worked in that sense. Next slide, please.
And if I could choose my hours, actual hours run along the x-axis, while desired hours run up the y-axis. Marc will explain the data in this line graph.
But then I thought, this was a lovely question in the data set. It said, okay, tell us what hours you actually work and tell us the hours you would choose to work if you had a complete freedom of choice. So the red line, which goes from bottom left to top right, that would be anyone on that line would be someone who currently works the hours that they would choose to work if they had complete freedom of choice. As we noticed, there are not many people on that red line, and there's a very small part where wage employees, solo self-employed and job creating entrepreneurs cross over. And actually the only place where all three intersect with the line of equality, which is a red line, is between about 30 and 40 hours per week. So what we used to call the standard working week. If we go to the very bottom left, so a person who works part-time, on average 20 hours a week, given a choice, they would choose 25 hours, so more hours. At the extremes, a person who works 60 hours a week would choose to work 50. So everywhere in the spectrum, if you work part-time or very, very excessive hours, very long hours, given a choice, you would not work those hours. So I think that's also interesting, and it kind of reinforces the influence of the favourable tax treatment and the trade-off between more income and more work-life balance, for example, that people face, and the choices they make, which in this case I'm arguing were incentivised by government and their favourable tax treatment of entrepreneurs. Next slide, please.
Is IR35 killing the entrepreneurial goose?
Okay, IR35. Now, apart from probably banks in the global financial crisis, IR35 seems to have generated a consistent wrath amongst self-employed people for at least 10 years. And there are very, very strong lobby groups arguing against it. So my question is IR35, given that since Margaret Thatcher, the government's been actively encouraging more people to set up their own businesses, more people to be self-employed, etc. But then HMRC comes in with the IR35, which I'll explain in a little bit, which seems to go contrary to everything every Prime Minister and Business Minister has said since 1979. Next slide, please.
Policy issue 3. This slide has 4 bullet points which Marc will read.
So in the year 2000, they introduced new and very strict legislation which tightened the rules around the legal classification of self-employment. and they're very strict definitions. And the policy target was to eradicate what they perceived as fake self-employed workers, who were really waged employees in disguise, but in cahoots with their employer. They reclassified themselves as self-employed, so the self-employed person would benefit from lower taxation, and the firm would have reduced employment costs, pensions, employers' NI, etc., etc. So HMRC didn't like this, particularly in the construction industry, which was the first industry in the UK to really enact the shift in the 80s from waged employment, unionised employment, to self-employment for many of the skilled trades in building. Progressively, they tightened the legislation to the point where from April next year, all public sector and medium large size firms who contract with self-employed must effectively prove that the people they contract with aren't really employees, disguised employees. So there are significant costs all the way through. So what I want to look at now, or appeal to the evidence, to say what actually happened, and potentially were there unintended consequences arising from HMRC basically trying to reclassify fake self-employed people back as waged employees, and hence raise higher taxes or get more taxes from the same workers. Next slide, please.
HMRC, they shot and scored. This slide shows a line graph showing inflow in grey, outflow in red, and self-employed workers in blue. Along the bottom is the year going from 1990 to 2005. There's a green vertical line coming from the year 2000 labelled IR35. Marc will explain what the data shows.
Okay, so the red line is really the one that's important here, which is the outflow from self-employment. The green vertical line is when the IR35 literally came into legal being. We see actually the late 90s was a boom period, largely, lots of nice wage jobs around, and certainly there's evidence that talented self-employed people were accepting very well paid jobs in the wage sector during that period. But in the post IR35 period, which was actually a recession, the early 2000s, we also see an uplift in outflows from self-employment, and at a time where inflows, entry into self-employment, was fairly modest and unchanging over a significant period of time. So in that sense, the policy worked. HMRC got their revenge on the fake self-employed, as they would consider them, despite the rest of government encouraging people to become self-employed over a 40-year period. Next slide, please.
The IR35 displaced self-employed. A medal shows the text HMRC, more tax collected per round of earned income. Bullet points covering employers, former self-employed, and the UK economy will be read in full by Marc.
Okay, so HMRC, certainly from the people that they would see as fake self-employed, who then just were employed by the firms they were contracting to, they certainly collected more tax per pound of income. So HMRC, gold star, they had a policy, it worked in a narrow sense. But what I'm really interested in my research when I look at policies, the unintended consequences. So other effects which HMRC clearly didn't consider when they were designing this policy. So from my work around this, so for employers, higher tax burden. So they have to pay employers' national insurance, holiday, now pensions, etc., etc. Some of them you'd consider a good thing. But for the former self-employed who were re-employed in a wage position, their gross income went down by 8.5% on average, which is quite a significant drop in income. And then if you add the higher tax burden on top of that, their net incomes were even lower than the 8.5% gross. So it's punished the former self-employed who were lucky enough to be re-employed in a wage role to a significant degree. The wider consequences, the one they clearly forgot about, was that around a third of the self-employed population are actually small business owners who employ other people in a wage job. So every time 3 of those people leave, in fact, every time 1 of those people leaves, another job is lost, an additional job from their employee is gone. So there's a double penalty. But on average, for 3 exits from self-employment, there's 1 additional job lost. But the real unintended consequence, HMRC naively believed that firms would just hold their hand up and say, oh yeah, we got it wrong, we tried to pull the wool over your eyes, and actually these really are employees, so we'll just take them on the books. But that didn't happen. Not all of the exits moved into wage jobs. Many flowed into unemployment, and even HMRC knows you can't tax the unemployed. So that encompasses my work. So I know the rationale that government uses to justify a policy. I can measure the effectiveness in a narrow way with fairly good clarity, but I'm really interested in the unintended consequences and tracing out the full effects every time government does something, and that's really where my work has been for 30 years. Next slide, please.
Are bankers evil?
Okay, this arose out of actually the very first piece of research I did was in the 1990 recession, and we had the same story. Roughly every 10 years we have an economic recession or some kind of crisis. It normally starts in a year beginning with 0 and ends in a year beginning with 3. And every time it happens, we get massive media coverage about entrepreneurs, small business people who've had their overdrafts withdrawn by banks, or they're being turned down for loans, etc., etc., and general media hysteria about how nasty banks are. Banks don't help themselves by often announcing bonuses in January in the middle of a recession when small businesses are suffering. So my broad question is, are banks evil? My real research question is, do banks in the UK serve small businesses in a reasonably efficient and helpful manner? Next slide, please.
Policy issue 4 has 2 bullet points which Marc will cover in his speech.
So that's my broad policy issue question, but it's certainly small business financing and imperfections or problems in capital markets, particularly with banks, but also with venture capital, have inspired a lot of government thinking, a lot of government commissions, reports, and a lot of very, very good and proactive policy making in debt markets and equity markets. And they've all been targeted at removing perceived constraints on access to finance, particularly for small businesses, but also young and innovative companies. Then on the back of that, there have been consistent concerns about potential discrimination in access and the terms of bank loans to women entrepreneurs particularly, but also to ethnic minority entrepreneurs. Next slide, please.
Just how big are UK banks? A graph titled Chart 7, Sizes of the UK and US Banking Systems, shows the difference between the percentage of GDP in UK and US banks from 1960 to 2010. The United States is shown in pink, the United Kingdom in blue. Marc will explain the data in a few moments.
Okay, but to understand the way small businesses, entrepreneurs and banks interact in the UK, we need to go back and understand the evolution of the banking sector in the UK and its importance, because that underpins government's general support, as we saw in GFC, underwriting or overtaking banks and their activities, and managing banks through crises rather than directly intervening to help small businesses who were suffering from a banking crisis. So if we go back to the 1960s, we see that in the UK and the US, the banking sector was the total assets held within the banking sectors of the US and the UK were well below what the US and the UK earned each year, measured by GDP. So it's below 100. Since the United States banking system has stayed below its equivalent GDP for 60 years now. That's clearly in very stark contrast to the UK, where the banking system, we had waves of all sorts of regulation all the way through, from Building Society Acts, all sorts of demutualisation, all sorts of freeing up of the banking sector, if you like, and its activities. And we've reached a point now where the banking sector, or the assets held within the UK banking sector, are nearly 6 times as big as the whole UK earns in a year. It's absolutely monumental, the relative scale and importance of banking in the UK, even compared to the US, where it's less than the equivalent GDP. So the banking sector in the UK is unique in the whole world, and 6 times bigger in a relative sense than its US comparator. Next slide, please.
Loan, demand and supply in GFC. A line graph titled UK SME Loan, Demand and Supply 2008 to 13. Marc will describe the data.
Okay, so this is looking at the global financial crisis period, which began in October 2008. So it's mapping out The blue line is the proportion of SMEs who applied for a bank loan going from GFC, the immediate period, the month after GFC, right through to Feb 2013. The yellowy orange line is of those firms that applied for finance, how many got, or what proportion of them were given a loan. Now, the really interesting bits for me, I mean, just eyeballing the two lines, every time the blue line goes up or down, which is the I'm a small business, I would like a loan, please. The yellow line, the willingness of banks to actually give you a loan, goes in the opposite direction. So starting from the left-hand side, so 2 months after GFC, banks were being very nasty in terms of reducing their willingness to offer loans at the same time as more small businesses were asking for one. And then over time, if we go up to the period to autumn 2011, banks were actually getting nicer in terms of more willing to supply loans to SMEs at exactly the same time as SMEs were reducing their demand for loans. So what's clear in any crises is that banks initially overreact. They credit ration too much, too severely, but small businesses act almost in a 3-month time warp. So a small business today observes a bank being quite harsh in terms of its lending policy, and then it thinks about it, and then it reacts to a world in 3 months' time that doesn't exist anymore. So it's completely out of equilibrium, and it actually took round about 3 or 4 years after the global financial crisis before we got back to an equilibrium where small firms and banks were singing from the same hymn sheet. Next slide, please.
Loan application and success rates in Europe. This bar graph shows the countries of Europe up the y-axis. Each country has 2 bars along the x-axis, one in blue showing success rate and one in red showing applications. Marc will give context to this graph and then explain the data in a few minutes.
Okay, everyone lauds particularly the German banking system, but more generally the continental European banking system. Our banks dominated by 4 banking groups who have about 80% market share of SME accounts and SME lending, and they have done for about 30 or 40 years. So our big banks invest billions in IT, clever credit scoring algorithms, etc. And that's called transactional banking. It's based on hard data. 40 years ago in the UK, we used relational banking, where you would have, as a business, you would have a local bank manager who would know you, understand your business. You'd meet socially, possibly. So that allowed the transfer of softer information, which would then inform their lending decision rather than just some computerized algorithm. That was then in the UK, but that kind of system is still very pervasive in Europe. So in terms of the application rates, UK on average, our businesses are less reliant on bank financing than those Spain, Italy, France, Germany, etc., which are heavily bank-based systems and relationship bank-based systems. But the blue bars, which are of all those businesses which applied for loans, how many were successful in obtaining finance. Then, I mean, Greece was in a particular economic spot, so success rates were very low during that GFC period. But generally, UK success rates for loan applications were kind of approaching 85–90%. So we're not too far out of kilter with success rates for relationship banking systems and countries. Next slide, please.
Loan interest rates in European countries. A bar graph titled Net Interest Margins 2014. The graph shows a bar for each country. Along the x-axis is interest rate, with Belgium at the top with the lowest rate of 2.5% over base rate, and Greece at the bottom with the highest rate of almost 8% over base rate. All the countries are in dark blue except for Austria in yellow and the UK, Germany and Italy in red.
Okay, so then the issue is, or a fundamental issue when you're accessing financing, is the interest rate you pay, the net margin over base rates you pay on borrowing, and that ultimately affects either the ability to repay a loan and B, the types of projects that are needed to meet those kind of loan and interest repayments. Here we see actually loans in the UK to SMEs, the margins are quite low, less than 3.5%, about 3.3% on average. Whereas the relationship banking systems, the big ones, Germany, the average small business pays 5% on lending. In Italy, more than 5%. Obviously in Greece, for particular reasons, very, very high interest rates. So in that sense, although there are clearly problems in the immediate period after a crisis, be it COVID, be it global financial crisis or any other deep economic recession, for the most part, I would suggest that UK banks, whilst their bonus systems might be evil, generally they provide a pretty good service and have a fairly good relationship with their small business customers compared to their European counterparts. Next slide, please.
Thinking about the whole bank-firm relationship. Chart 6, UK banks, sources of earnings. This is a graph running from 1980 to 2005, with net interest income left-hand scale in solid blue, non-interest income left-hand scale in solid red, and a yellow line showing non-interest income, net interest income right-hand scale. Marc will explain what this graph shows.
And why is this? And what this graphic shows is where banks, or how banks earn money from customers. And the blue chunk is their interest income, which is the money from lending, effectively, their income from lending. And the red bit is their interest from services and other charges, banking services. But the important part of this, which is the orangey yellow line, is that the importance of non-lending associated income or earnings for banks has increased dramatically, from about 40% in 1980, a ratio of 0.4 in 1980, to a ratio of 1.8 now. So 2/3 roughly of the profit a bank makes from a small business account or even a customer account, is non-lending associated. So I would argue that banks, unlike government, look at the whole relationship, and they'll often give you soft lending. That's why we saw the relatively low interest rate, willingness to lend, because that locks you in as a profitable customer, and they'll make extra profit from the other bits of your banking. You know, when they charge you 10 quid for being overdrawn for about 2 minutes, or arranging a currency exchange, etc., etc. So it's erroneous for policy makers and also banking commissions to separate out the different elements of a customer-bank relationship, because that's key to understanding the lending side of things. Next slide, please.
Lending and gender, aspects of entrepreneurship, demand. A line graph shows percentage of SMEs applying for bank finance from July 2011 to March 2013. Male-owned businesses are shown with a dashed black line, female-owned businesses with a solid black line.
Then getting into the concerns about gender discrimination here. So what inspired a lot of the unsophisticated discussion and debates, and also initially the policy thinking around this, was the observably lower rates of female entrepreneurs applying for finance. Consistently over time, I mean, this is a short time window here, but male entrepreneurs and business owners over time and countries always have a higher rate of applying for bank finance, bank loans. And that's often erroneously taken as evidence that there's some discrimination in the market. But there are other reasons for that. Women have a higher level of retained earnings. So when they make profit, because they're more cautious, more risk averse, they'll tend to save more profit in the business. Hence, they have less need for external finance. Next slide, please.
Lending and gender, aspects of entrepreneurship, supply. This line graph shows the percentage of SMEs receiving at least part of finance supply from July 2011 to March 2013. Again, a dashed line shows male-owned and a solid line shows female-owned businesses.
And here we see that on average, in most time periods, female funding applications, female entrepreneur funding applications are more likely to be received favourably by banks. So they have a higher success rate than their male peers. So actually, not only is the initial discrimination kind of arguments, debates, not rooted in evidence, but in fact there's evidence to the contrary. But we'll see from the next slide.
The twist in the tail, over-optimism and gender. A graph showing entrepreneurial overconfidence on the x-axis with male-led in red and female-led in blue. Marc will describe the data.
This is actually to do a lot with what in business literature they call hubris. I call it kind of over-optimism and other things depending on the people I'm with at the time. What this does is, so the bottom axis is, so 0 on the horizontal axis is where your ability matches your judgment of your ability. So anyone with a minus figure undersells themselves or doesn't realise how good they are. So they're underconfident. Anyone to the right of 0 going positive increasingly overestimates their true ability. So they're more hubristic the further right you go away from 0. And here, male business owners are in red, and women in business owners in blue. And this maps out the relationship between your judgment or misjudgment about your own ability, your true ability, and the likelihood that a bank will give you a loan. Now, what we see in the middle bit, so people whose judgment of their true ability is quite close to their actual ability, so realistic people, entrepreneurs in this case. So women, for most of the fairly realistic range of entrepreneurs, are more likely to get a loan application approved. But the interesting bits are at the tails. So for a very unconfident male and female entrepreneur, an unconfident female entrepreneur who understates their true quality, only about 40% of them will get a loan. But for an identical male entrepreneur, that's getting up to kind of 45% of them will get a loan. So a significant difference for unconfident entrepreneurs on gender. But if we go to the, I think I'm super man or woman, but I'm really not, end of the spectrum, so the right hand side, again we get a gender difference, again in favour of male entrepreneurs. So if you're full of rubbish, a female entrepreneur will be penalised more heavily than a male entrepreneur, given that they're both so over-optimistic or hubristic about their true abilities. And there the gap, the gender gap, is much bigger than for the unconfident end of the spectrum. So it kind of goes into some quite interesting territory that myself and Sue Marlowe and various people are having a think about. And where we've got to now in our thinking is that banks like realistic entrepreneurs. They particularly like realistic female entrepreneurs. But if a woman entrepreneur particularly oversells herself, then the penalties are quite harsh, certainly compared to their male peers. So there's some interesting twists and tails, but the gender bit doesn't stack up on the broad base of the evidence. Okay, next slide, please. Okay, is Brexit damaging for business? I'm ignoring the policy things. My simple question is, we're likely to head to some kind of tariff based trading system, certainly for businesses that trade into the EU. So what are the consequences? Next slide, please.
Policy issue 5, Brexit tariffs and international trade. This has 2 bullet points, which Mark will read.
So before Boris and Donald, we were always looking at trade liberalisation, the removal of tariffs and non-tariffs, which are generally around standards, the world forming into economic blocks. So it's all about free trade, effectively. Next slide, please.
Effects of tariffs on UK firms trading in the European single market. A table with columns along the horizontal showing the percentage of a firm's competitors which are local, regional, national, EU and world. Vertical columns show the geographic region of the firm's main market, again from local through regional, national, EU and world. Highlighted text shows 42.8% of UK small businesses trade into the EU in direct competition with EU SMEs.
But my concern is that our best small businesses, those who compete in Europe against European firms, if there was even a modest tariff, 10%, so a 10% increase in the cost of doing business, what would the consequences be and how many firms would it impact on? And the 42.8 of UK small businesses trading into the EU as their main market and facing direct competition from EU firms who don't have a tariff because they're in the single market. So next slide, please.
The consequences. This slide has 4 bullet points which Marc will go through.
So I estimate around 41,000 UK SMEs compete directly with European firms and just over 7,000 largely within the European single market area. So my predictions are that even for a baby tariff of 10%, and some tariff schedules are about 30% on certain goods and services, a small business, the average small business trading in the Euro single market area would suffer a decline in sales of about £700,000 per year. So aggregating that up across all those small businesses, it's about a total revenue loss of about £5 billion to UK SMEs. But more importantly, they're our best SMEs because they're internationalised, they're making sales in international markets, which clearly benefits the UK more than internal trading businesses. Even more worrying in the world of chlorinated chicken, that an additional relaxation regulations around standards, which are non-price bits of trade, would make this problem even more severe for UK businesses trading into Europe. So Brexit for businesses, particularly small businesses, my area of particular interest, would be an absolute economic nightmare. Next slide, please. Okay.
Can we rebalance the economy away from the southeast, and are regional investment funds part of the solution?
The southeast is clearly the economic, the wealthiest region and the economically most robust, if you like. But governments, well, even now Boris is on about his levelling up agenda, etc. Then a part of that with the Midlands engine that we're in at Derby, but all the other engines, etc. Business angels and venture capital has been fundamental part of the policy solution. We're talking about regional investment funds, regional venture capital funds, support for business angels to channel money to our best small businesses, our most innovative companies. So I thought I'd have a look at patterns in business angel activity, where they live, where they invest, and see if we're any nearer to a levelling up or rebalancing agenda. Next slide, please.
Policy issue 6, creating a regional investment base. This slide has 4 bullet points which Marc will go through.
So we've been at it quite a long time in the policy sense, and in my opinion, the single biggest small business policy failure was regional venture capital funds. You don't need to understand all the financy terms to know that they were an absolute dog of an investment, a way of channeling money. They lost money on their investments. 36% of the total capital raise was paid out in management fees. And then I have a particular problem. I don't have a problem with rewarding performance with pay, but I do have a problem where fund managers take out a third of the money, capital, and then lose my money on the back of it. So have we done better in the intervening period from the 90s till now? Next slide, please.
The geography of business angels. A map of Britain divided into counties, all in different shades of blue. Darker blue counties have a higher concentration of business angels. Marc will describe the data in full.
And that simply maps out where business angels are and where they invest. The darker the shading, the more thick the market is, the more business angels making investments in businesses. Again, we see the darkest goes all the way across the south, actually, including southwest. Reasonable representation of angel investment activity in the West Midlands, Yorkshire and East Anglia, around the kind of high-tech bits around Cambridge. Very low levels of activity in our own area of the East Midlands, the Northwest and Scotland, and even lower levels of activity, Northern Ireland, Wales and Northeast. So significant geographic issues if we see business angels as part of the solution to the levelling up agenda and the rebalancing economy agenda. Next slide, please.
Business angel investing and geography. In red on the left side of this slide, arrows point toward 3 advantages of local investors. In blue on the right, arrows point towards 3 advantages of regional and national investors.
So what do we get from local angels, which policymakers think is the dream? Certainly that only accounts for 25% of angels who invest in their immediate locality. The rest invest further afield. You're more likely to get strategic management support. We would generally agree that's a good thing. They're more willing to lose their investment capital. They're more willing to take risk, and they make larger single investments. So they're kind of generally good things. But the flip side of that, so if I'm a business angel, particularly in one of the light coloured regions of the UK, I've got a 3 in 4 chance of not investing in my own region. But I also have other attributes that are very beneficial, particularly for levelling up. I'm more experienced as an investor. I build larger portfolios so I can diversify risk and help more businesses. And particularly important from a policy and a levelling up agenda is I'm more willing to invest in early stage businesses. So plenty of work to do. I do think business angels are a key part of the solution, but where we're at now, the dominance of the Southeast, not only do they have more angels investing locally, but they attract the finance of angels from other regions who are desperately and more in need of cash equity investment. So more to do there. Next slide, please.
COVID-19. Who suffered more?
COVID, who suffered more? We better whiz through this. So next slide, please.
Policy Issue 7, the asymmetric policy response. This slide has 3 bullet points which Marc will explain.
We know the stuff around lockdown. We've all lived it. we know the furlough scheme and the self-employment equivalent, which was actually less generous. So it's based on 70% of average trading profit rather than 80% of salary. So it's asymmetric policy response, depending on whether you were waged, very helpful, self-employed, less helpful. Next slide, please.
Deterioration in well-being. On the left are the key negative effects in red, which Marc will read out. On the right, in blue, are elements with no effect. At the bottom, it states, for a common reduction in hours and income, the self-employed suffer a greater deterioration in well-being than waged employees. The deterioration in well-being caused by losing hours is nearly 3 times that caused by losing income.
So I looked at the well-being effects of COVID and who it impacts on worst or most. Clearly, those who suffered a reduction in hours and incomes, those not protected by furlough, suffered negative well-being effects. Now, the interesting ones for me were younger people and females, but from my general body of work, which is concerned about self-employment, self-employed suffered disproportionately in a well-being sense from the COVID kind of lockdown. Interestingly, we tend not to report nil effects, but there were no ethnic effects, key worker effects, having children, or bizarrely, your COVID test status. So even people who tested positive didn't appear to suffer any further negative well-being effects. Next slide, please.
Rishi saved us, but wants payback now. A line graph of UK national debt percentage of GDP since 1727, credited to economicshelp.org. Peaks in the level of national debt coincide with the Napoleonic Wars, World War I, World War II, and the 2008 financial crash. Debt dropped swiftly in the post-war boom after World War II.
Now, I'll whiz through this quickly, but I'm concerned that even though Rishi saved us in one sense with the furlough scheme, etc., now he's talking about clawing the money back. And yesterday they leaked to the media a desire to reduce the international aid budget, for example. So he's desperate to claw it back in a very short time period. But what UK history going back to 1760 tells us is that in wars and other crises, the ratio of national debt to GDP rises significantly. And now it's only about 80% now, even with the additional spending, probably only go up to 1.2 times GDP. So way below historical precedents. But the key lesson for me is that everyone appreciated that with whatever the crisis was, Napoleonic War, World War I, World War II, GFC, governments have taken a longer view. Like it's unrealistic to try and pay back an unprecedented and unanticipated increase in debt in a 5-year political cycle. So I would argue that Rishi needs to forget that and treat it as a generational debt and just pay it back as you would do a mortgage over a 25-year period, particularly as borrowing is so cheap at the moment for governments. Next slide, please.
Does entrepreneurship pay?
The final one, which is, I guess, crucial if you've been encouraged to become an entrepreneur by the government and by favourable tax regimes, etc. Does entrepreneurship pay? Next slide, please.
Policy issue 8. Should we encourage more people to start their own business? This slide features 3 bullet points. First, as we saw from slide 6, all UK Prime Ministers since 1979 think we should encourage more people to start their own business. Second, very few people have questioned whether this is an economically good thing for people to do. Third, asks what is the defining characteristic of airport entrepreneurs?
Okay, what really annoys me are these what I call airport entrepreneurs, and they've got one defining characteristic. They have an elite education and they have extremely wealthy and well-connected parents. For those of you concerned, the fees at a dance college range between 8 and 30,000 a year, depending on whether you want full board or just day tutorials. So I completely ignore any advice, what makes a great entrepreneur in books written by these kinds of people. They just throw away airport books to me. I'm more interested in the broad populace, which is about 5 million people who've chosen a self-employed or small business path. Next slide, please.
Income and Entrepreneurship 1. A bar graph shows the level of earned income of full-time workers per month. In blue is self-employed, red is small business owners, and grey is waged. Marc explains the data.
So, again, we've got the breakdown between waged employees, solely self-employed, and small business owners. And what we see, this is across the whole of Europe, so the numbers won't really make sense, but we've got deciles in the earnings distribution, so 10% chunks, if you like. And what's clear is that only in the top quarter of entrepreneurs do they earn more than they would do their twin brother or sister would get in a wage job. And the individual self-employed, significantly less across the whole income distribution. So for the self-employed, it doesn't pay compared to their waged equivalent. And only for the very elite small business owners does it pay in an absolute sense. But we also know that both types of small business owner work longer hours, and that's just their total income. So the next slide paints an even more stark picture.
Income and Entrepreneurship 2. A similar graph, only this one is showing income earned per hour instead of per month.
Here, only the top 10% of small business owners earn a higher hourly income than they would do if they were in a comparable wage job. Everyone else in the whole distribution would be better off in an hourly income sense being employed by a company. So entrepreneurship does pay, but only for 1 in 10 entrepreneurs. Next slide, please.
Summary, which Marc will read.
So I've covered all sorts of issues, but they all had a policy underpinning: efficiency, hours, taxes, banking, Brexit, regional investment, COVID, income. So hopefully you've learnt, or certainly gained an insight into the types of work I do, the issues I look at. Next slide, please.
What I think we've learned. 5 bullet points, which Marc will go through.
I mean, you can draw your own conclusions, but from this, small businesses are relatively inefficient. Taxes incentivize people to do things they wouldn't choose otherwise. The benefits of a cunning policy, IR35, can be negated by the unintended consequences. So we need deep thinking. UK banks generally serve small business quite well, and when they don't, our government has a really good track record in intervening in capital markets. Banks can spot hubris a mile off and act accordingly, but we just get these quirky results at the extremes where women entrepreneurs who generally benefit from their realism are penalised for being completely unrealistic at either end of the spectrum. Next slide, please.
This is a continuation of the last slide with 6 more bullet points under the heading What I Think We've Learned.
So tariffs, if we do move to a tariff-based regime trading into Europe, then I think that will be a hugely devastating thing for our best businesses. I think angels are a key part of the levelling up solution, but we've got so far to go with that. COVID's caused a very significant deterioration in well-being across the population, but particularly hard hit are young people, women and the self-employed. Importantly, work in its own right has a bigger well-being effect than income. So people actually, there's a value in work which transcends the money you earn from it. High quality entrepreneurship is rare, and government needs to just take a bit more time when it thinks about policy and how to resolve issues, and certainly in the first instance make sure its evidence base is there. That's me, thank you.
This slide has grown to fill the screen and the video of Marc has gone. Thank you is written in a red box. Behind the text is a photo of a student reading a book. She stood in the University of Derby's library next to rows of books on shelves. The 3 peaks logo of the University of Derby in white against a dark blue background. Text underneath reads, "Find out more about research at Derby, derby.ac.uk/research."